Welcome to the December edition of Seattle Apartment News. I'm Matt Johnston with the Simon Anderson Multifamily Team here in Seattle. We're joined today by a special guest, Chris Medawar. Chris is someone that our team has collaborated with quite a bit over the years. And why don't you share just a little bit more about your business, what you're focused on here in Seattle?
Yeah, so we are primarily family office, plus syndications, buying smaller value-add apartment buildings here in Seattle. And we also run a property management business, Medawar Real Estate, doing third-party management. So we are well in the details of Seattle apartments.
That's awesome. Well, thanks for being here. As most in our industry are aware of, the recent Seattle mayoral election results were less than favorable, I think, for most of us. So that being said, I guess in the position that you're in our industry, what are, I guess, a few of the things that you have your eye on as the most concerning or impactful ramifications that might come from the mayoral election, city council, and things like that next year?
Sure. So number one, I think property owners need to be aware that there's strong political will to increase property taxes. I think over the next 5-10 years, you should expect property tax rates to increase faster than the rate of inflation. Number two, obviously we just passed rent control statewide, making it extremely important for property owners to keep their rents at or close to market. You have to follow the new rules on serving rent increase notices, and it is strongly in your best interest, even for great tenants that have been around for a long time, to keep your rents as close to market as you can. In that same vein, with the local elections going the way they did, on Katie Wilson, the new mayor's platform, she wants to decrease the cap where you, under current Seattle law, if you raise the rent by more than 10% and the tenant is income qualified and moves out because of your rent increase, you have to pay them 3 months rent as a move-in, as a relocation penalty. I strongly suspect that 10% cap will be lowered to 5%. And I think that's going to be a priority for the city. So we are expecting that change. And we're also expecting that if you serve a rent increase greater than 5%, you have to serve an extra form with it. So there's going to be a procedural change as well with the rent increase notice.
Yeah, that all makes sense. Those are things that we're tracking as well. I mean, obviously, as you mentioned, on a statewide basis, the rent control cap was implemented, and from my understanding, local municipalities cannot preempt that and make things more favorable towards tenants from a rent increase cap standpoint. But as you said, on the tenant relocation assistance front, lowering that cap from 10% in Seattle, where it is now, to 5% would obviously mean that owners and operators, are on the hook for, like you said, more challenging process in terms of documentation and notice periods and stuff like that, as well as financially assisting them if they choose to move out if their increase is over 5%, which, as we know, 5% in an annual year, we've seen rents go up, at that level in years past, maybe not, in the most recent years, but something definitely to keep an eye on as we move forward.
And I believe the city of Olympia already has a relocation assistance program at 5%. So I do not think that will violate state law. And, property owners are going to have to consider, do I want to increase by more than 5% and be potentially subject to this 3-month penalty? Is that 3-month penalty worth the difference between 5% and 8%? Probably not. So it may effectively cap rents at 5% in the city. Although keep in mind, if you're buying great properties in great locations, your tenants probably make more money than the income cap. So more likely than not, they won't qualify for the program, but understand that it's out there.
Yeah, and with those things in mind, I guess how are those concerns of potential things to come impacting how you're looking at deals on the acquisitions front, or how you're talking about deals with management clients that are looking at acquisitions? Obviously, like we talked about, being judicious about making sure that your rents are as close to market as possible, and that you're looking, down the road at expirations and rent increase notice periods, and staying on top of those things. But are you, underwriting deals differently because of these things?
Sure, yeah, that's the big change. The big change we've had to make in response to these laws is changing how we buy buildings. We used to buy buildings with the assumption we might be able to bring rents to market within a couple years. Now you have to go into a purchase assuming that you can only raise the rents by 10% a year. So you need to underwrite existing rents and pay for existing rents. And it's worth it to pay a little more for higher in-place rents with great tenants, with great tenant credit quality, because they're going to pay on time, they're going to keep their job in a downturn. You're going to have a lot easier time managing the building. So we're paying attention to in-place rents, in-place operating income, and tenant quality on our purchases.
Yeah, I think those are all great points, and we've noticed definite shift in terms of the importance that investors are placing on in-place income and trailing income. We're still getting some deals done at very low cap rates from in sellers that have maybe owned properties for a long period of time and are not inching rents towards market, or have out of whack expense loads or things of that nature. And we still do have clients that are looking for a big value add pop and moving that NOI. But I think the biggest difference to your point is that the time it's going to take you to achieve that lift in the NOI is longer. And then going into the deal, I guess just the price that you can pay for that deal on a price per unit or a price per foot basis is something that you have to be ultra sensitive to, especially if you're going to have to add into your budget, say, cash for keys or relocation funds to tenants in order to create vacancy and renovate units and lift those rents to market. So, Chris, we're hearing from a lot of owners throughout the Puget Sound, depending on where they own or what the building profile is, that for this time of year and right now, they're experiencing a bit more vacancy than they have in years past, and maybe a little bit of softness in rents, more so than we anticipated. Granted, seasonality is a real thing here in Seattle, but what are you experiencing, I guess, across your portfolio, whether it be properties that you own or that you're managing for clients on the vacancy front?
Sure. Over the last 2 years, I would say seasonality has been more pronounced, where if you're leasing this time of year, it's taking much longer, and concessions are up across the board. So we're offering a month free in a lot of cases, and we think it's better to lower the rent and get someone in there as opposed to hold out for a higher rent and incur a longer vacancy. So we're definitely seeing, really depending on location, some units releasing at lower prices, but overall we are still getting our portfolio leased. There's plenty of good tenants out there. It's very location dependent. If you are close to a lot of new development, you're competing with that new development, and you're going to have some softer rents. As opposed to the really prime location, Fremont, Queen Anne, Green Lake, with fixed up units, we're still not having much of a problem getting those units leased.
Nice. Yeah, that tracks, I think, with a lot of what we're hearing from other clients as well. And heading towards 2026, I think that most of us have looked at the development pipeline and seen that we have delivered a ton of units, no doubt about that. But a lot of those have been absorbed, and we're starting hopefully to get closer to an equilibrium in terms of supply and demand. But I guess what are you predicting as we head towards 2026 on a rent growth front? Do you think we'll start to see that rent growth that we've been talking about for the last couple of years?
We'll see. I think in, again, seasonality, it's like clockwork. Every April, May, June, you're going to get premium rents and get your units leased quickly. I think Seattle is still a beautiful city. Our government has done a lot of great work on pedestrian infrastructure and getting the waterfront project complete. The World Cup should be a huge boom for the city. We'll see if they're able to get the light rail across the bridge, but it's still a beautiful place that people want to move to, and we've got a great economy. So I'm still expecting great things long term. As far as the fundamentals, property tax rates increases have slowed, although as we previously touched on, I'm expecting them to increase long term. The insurance rate increases have slowed. Interest rates are no longer increasing at a rapid clip. And as you touched on, the development is slowing. So all those factors point to strong real estate fundamentals over the next 3 to 5 years. Is that going to happen over the next 6 months? I don't know, but if you wait for all the lights to be flashing green, it's too late by that point. So we're still deploying capital strategically and bullish on Seattle over the next 5-10 years.
Yeah, that's great. I mean, we are too. Obviously, I think that there's a lot to like in terms of employment drivers. The fact that Seattle and the Puget Sound generally is a place that tenants want to be. Light rail's been great, as you touched on, for tenants that are living maybe just outside of the core and commuting in, and we've seen, I think, some good progress in terms of downtown areas like South Lake Union, Queen Anne, come back to life a little bit since the pandemic, and a little more return to work, which I think is great for the city and reverberates out to all the main markets that you're invested in, that we transact in Seattle. And you mentioned you guys are still deploying capital and looking at deals aggressively and buying deals. We've been hearing from a lot of clients that it's not the easiest time in the world to raise equity right now, outside equity for deals, but that the right deals are getting done. And we've seen transaction volume tick up pretty substantially this year compared to last year on the brokerage front. When you're out, talking to investors or other people in the industry, what kind of deals on a acquisitions perspective are they most excited about, or are the easiest to get them kind of on board with when you're raising money to try to go purchase?
Sure. I think people want to see in place, they want to see cash flows and distributions quickly. So that goes back to the previous conversation we were having about paying for in-place rents as opposed to what you think the property can operate in the future. We're seeing a much greater appetite for paying for how the property is operating now. And sellers don't want to hear that, but I think slowly but surely sellers are coming to that realization, and more deals are getting done. I think it's still going to be, maybe a year or two before it's boomtown, everyone's partying again, but things are fine.
Yeah.
Things are fine.
Yeah, no, I think that's a good point. We've seen sellers that are transacting for a variety of reasons, and I think when a seller has made up their mind to meet the market when they go to sell their property, and we then do our best to create a market and deliver as many offers as possible to really establish here's where pricing is today based on all the things that investors like yourself have to think about in terms of some of the challenges here in the climate that we're in, that some of which are not unique to Seattle. I think on a macro level, people are a little bit of a wait and see mindset in terms of the broader economy.
Yeah, that's a good point. Keep in mind a lot of the struggles we've had over the last 3 or 4 years. We like to blame on our overregulation in this city. It's not a local story. This is a national story where there's been a ton of new supply, expenses are up, and rents are down. And in fact, the overregulation might be helping us. Rents are down further in Texas and Florida and other markets where it's not quite so hard to operate. So the downturn was a national story, not a local story, and hopefully the upturn that will come will benefit us.
Definitely, yeah. I mean, on a more optimistic note, obviously there's a lot of regulatory and economic worries or concerns out there, but I think there's a lot of clients and investors that we work with that want to be buying when others are concerned or maybe on the sideline, because that's really when you can avoid some of the competition and go pick up a property at a great basis. If you really believe in the long-term story here in Seattle and in the Puget Sound, which I think that we all do. So I guess on a more optimistic note, looking forward to 2026, what are some things that you're, I guess, most excited about or that get you, showing up to work every day excited and believing in the future and growing your portfolio here in Seattle?
We love fixing up our buildings, taking care of deferred maintenance, renovating our units, providing great housing. And if you do the basics and fundamentals of property management, you are going to do just fine in this business. And if you pay correctly for a purchase and operate it well, there's a pretty narrow bandwidth of how your asset's going to perform. You're not gonna 100x your money, but you're also not gonna. Your downside is really limited as well. So it's a great asset class for predictable income, debt pay down, providing a great service, and we're looking forward to continuing into the future.
Awesome. Yeah, I think to echo that, there's a lot that we're looking forward to as well. I think the stage is set pretty well for stronger fundamentals to return. Like you said, I think, whether that'll be in the first 6 months of 2026 or later in the year, if I was an expert at predicting the exact timing, then that would be one thing. But I think that long term and over the course of the next several years, just from pure development pipeline outlook, the job growth that we've seen here in Seattle, I think that in tech things ebb and flow, obviously, and we've seen some headlines about layoffs and things of that nature. But I think long term, the main tech employers are clearly investing in Seattle and growing overall, and things are trending in an upward and right direction. There's going to be some ebbs and flows there, obviously, but I think that there's a strong outlook for rent growth to continue and return. And in Capitol Hill, for instance, I believe there's 200 units that are under construction right now, just a historically low number. And so I think that if you're out looking to make a purchase right now, that there's some great opportunities if you're looking at the things that you mentioned: quality buildings, quality locations, quality tenants, and then you're trying to make your money on the buy to buy right and look at it from a long-term perspective. There's a lot of reason to be engaged and be out there looking for deals right now.
I agree.
Another policy change that we've been tracking recently and hearing about, especially from clients that are in the phase of their investment life cycle or career, and are winding down or planning for retirement or for the next generation in their family, is the changes to the estate tax law here in Washington State. Is that something that you've been having conversations with some of your management and other clients on?
Yeah, so I think it's something that real estate investors or people in Washington generally need to understand. Changes at the federal and state level this year with respect to estate taxes or death taxes. Federally, there's a 40% estate tax, but you'll have a $14 million exemption per spouse, per person. So there's a huge exemption at the federal level. But at the state level, we have had a 20% tax, estate tax, over $2 million. That was recently changed. The exemption was increased from $2 million to $3 million and indexed for inflation. And they also graduated the tax rate. So there are various brackets you can look up going up to 35%. So if you are a high net worth individual with an estate greater than $9 million, you could be subject to a 35% state level estate tax and a 40% federal estate tax, which is quite punitive and has a lot of people considering if they want to relocate their primary residence and potentially selling Washington State investments and moving them to other areas. This is something you need to talk with an expert regarding, an estate tax attorney, but be aware that there is a 35% Washington State level estate tax.
Yeah, that's great. I think that's something that's sort of flown under the radar, maybe for some investors and apartment owners that are maybe not quite, at the point of more thorough estate planning, but something that really amounts to a pretty significant increase, and something that that their heirs are going to be subject to. And so we've been having that conversation with a lot of clients, at the very least, just helping them understand what the change in net proceeds to their family would be after an event like that were to occur, just so that they can be fully educated and make decisions for themselves. I think that for a lot of people, they quickly jump into that. The way real estate's appreciated here, if you own a couple smaller buildings, a portfolio, or a couple larger buildings, quickly fall into that upper end of the tax bracket, and something for them to be aware of in terms of planning. If they might make more sense for them to liquidate assets here and maybe move those funds out of state, or just kind of reconfigure their portfolio in a manner that's going to be most beneficial for the next generation. Ultimately, I think that's what a lot of our clients are in the business for, is to build kind of generational wealth and portfolios for their families. And so it's important to track those things and safeguard your family legacy, really. Thanks for joining us for December's edition of Seattle Apartment News. As we talked about, there's a lot to look forward to in 2026, and some headwinds that owners, operators, investors should be keeping their eyes on. If you have any questions, or if there's anything that our team can help you out with, please reach out to myself or any member of the Simon Anderson Multifamily Team. Thanks, and we'll see you next month.